Okay, so this video is on investments in associates. So part one, we're going to go over the fundamentals of equity accounting. Part two, we'll deal with the inter-entity transactions. So what is an associate? So it is an entity over which the investor has significant influence over. So this means that they have the power and the capacity to participate in decisions relating to that entity, but they do not control them. So I guess what defines significant influence is that they hold over 20% of the voting rights, but it's less than 50%. So it's between that 20% to 50% bracket, because that means they have significant influence, but then they don't have control. So when we are accounting for an associate, we will use the equity method of accounting, which is what we're going to go through in this video. So the equity method has two broad steps. First step, we need to recognize the initial investment at its cost. Second step, we need to recognize the investor's share of any profit and loss, OCI distributions, or any other movements in net assets based on their ownership proportion. So in terms of these two steps, they differ slightly if the investor is a parent or if they're not a parent. So if they're a parent, step one is done in their own accounting records, so their own books, so they create a permanent record. But step two is done upon consolidation, so they do this in the consolidation worksheet, and so they're temporary entries. If the investor is a non-parent, both steps are done in their own accounting records. So what does this mean? So if our investor is a parent, it means that we need to look at the changes in equity or net assets from the date of acquisition to the beginning of the current period, as well as changes in equity in the current period. Why? Because if we're a parent, we're applying the equity method upon consolidation, and so they're only temporary entries, which we only apply on consolidation, so we have to look at the changes in the prior periods every year because we have to redo our entries. Whereas if we're a non-parent, we only need to look at changes in equity in the current period because we're applying the equity method in our own accounting records so that we create a permanent record. So once we've dealt with one period, we've got our permanent records in our accounting general ledger, and so we don't need to worry about it anymore. We just look at the next period going forward. So we've got an example here. So Deggers Limited acquired 25% of Rareco for $200,000 on 1 July 2015. So we can see Rareco's equity is comprised of 3 different equity accounts there, and all assets are at fair value except for some inventory and machinery. We also have some additional information. So Rareco revalued assets up $5,000 in the current year. Machinery had a remaining useful life of 5 years at date of acquisition, and 60% of the inventory was sold on 1 December 2016. The remaining amount was sold in the current year, and dividends declared are paid within 3 months. We've also got some financial statement information. So we need to prepare equity accounting journals for 1 July 2015, so that's the date of acquisition, and 30 June 2018. Okay, so the first thing we're going to look at here is a bit of acquisition analysis. So we know we paid $200,000, 25%. We've calculated our total equity. We've also done our BCVR calculations up here. And so our total equity equaled $1 million. And because we're only buying 25% of the company, we multiply the total fair value of the identifiable net assets by that 25%. So we know we're entitled to $250,000 worth of those net assets, but we only paid $200,000. That means we have a bargain purchase of $50,000. So when we are doing equity method accounting, goodwill upon this acquisition, we don't need to do anything extra because if there is goodwill, when we do step 1, we record our initial investment at cost. We will recognize any amounts of goodwill as well as the value of the assets in that initial recognition. Why? Because if we pay more than the assets, then we will be recognizing the entire value of the assets plus any extra goodwill in our line item. Whereas if we pay less than the net assets, because our first step is recording at cost, we need to record the amount that we paid. We won't be reflecting the fact that we actually entitled to more net assets. So goodwill, we don't need to do anything special. We just recognize at cost our investment. There's a bargain purchase. We need to consider the excess amount, so this $50,000, as part of the investor's share of equity in the period of acquisition. So we'll do that during the example, so that should make more sense later, hopefully. Basically, we just treat it as the investor's share of an increase in equity. So this is our equity journal for 1 July 2015. So this is date of acquisition. So regardless whether we have a parent or a non-parent, we need to recognize our initial investment at cost in our own accounting records. So Deggers Limited was the acquiring company. So they will recognize in their books a debit to investment in associate of $200,000. Why? Because they're recognizing an asset for this investment amount that they have paid, and credit cash because they obviously paid $200,000 of cash to actually acquire this investment. Okay, so that's step 1 done. We've recognized our initial investment at cost. Step 2 is to calculate the investor's share of equity. So the first thing we need to do is we need to look at our prior period share. So we only need to do this if the investor is a parent. Now the reason why I've explained earlier in the video is because if we're a parent, we are doing equity method upon consolidation. So these are temporary entries, which we need to do afresh each year. So every year we need to look at the years that have already gone by so we can make sure we recognize appropriately the changes in equity in those prior years. Whereas if we're not a parent, we use equity method in our own accounting records, so we make a permanent record in our books for that year. So once it's done, we have our permanent accounting record and we don't need to make any further adjustments. So our first adjustment, we've got our movement in retained earnings. So if we go back to our financial statements, we know we're preparing our accounting journals for 30 June 2018. So our prior period ends 30 June 2017. So between the date of acquisition and the end of the prior period, we have this movement of retained earnings of $53,000. So we know upon acquisition we have retained earnings of $765,000. And then our closing retained earnings at the end of 30 June 2017 is $818,000. So we know this is an increase of $53,000 of equity. So because we own 25% of our associate, we should be entitled to our fair share of that increase in retained earnings from the prior periods. So we put that $53,000 in our increase column. Next, we have the movement in general reserve. So that's $10,000. If we go back to our financial statements, we can see that in our prior periods, we have $5,000 in June 2016, $5,000 June 2017. So that totals $10,000, which has been transferred from our retained earnings to the general reserve. So it's not included in the retained earnings balance, but it actually was retained earnings. We've effectively just transferred it from the retained earnings account to the general reserve. So because it was retained earnings, it's just been transferred. We need to recognize our fair share of that amount. And so we put that $10,000 in the increase column. Now, our next one is our depreciation adjustment. So, again, we look back here, we can see that at the date of acquisition, the machinery had a carrying amount of $100,000, but its fair value was $120,000. So, from our point of view, Deggers Limited, who is the investor, we need to use the $120,000 fair value at the date of acquisition as our cost base. But Rareco will be using $100,000 as their cost base, or their carrying amount. And we can see here that the machinery had a remaining useful life of 5 years at the date of acquisition. So we know that Rareco will be depreciating at $100,000 divided by 5, so they'll be depreciated at $20,000 per year. From our point of view, Deggers Limited, the acquirer, we need to depreciate it using $120,000 cost base. So when we go $120,000 divided by 5, we will get $24,000. So we'll be depreciating the machinery at $4,000 more every year than Rareco. From our perspective, Deggers Limited, we want to depreciate $24,000 a year. Rareco wants to depreciate $20,000 a year. So we want to recognize $4,000 more expenses every year. But we can see we're calculating our share of prior period equity, so that spans from the date of acquisition to the end of the beginning of the current period. So we can see that's 2 years. So we need to make that depreciation adjustment for 2 years. So because we know we need to be depreciating $4,000 more every year, because it's 2 years, our adjustment needs to be $8,000. Okay, and because we want the after-tax amount, we multiply that $8,000 by 0.7, and so that gives us $5,600. Now the reason we want the after-tax amount, so if we've recognized a higher depreciation expense, this means we'd have less profits, and so we'd pay less tax. So higher depreciation expense would reduce our equity, but a lower tax expense would increase our equity. So when we offset the two, we get the after-tax amount, which nets out to be a decrease in total equity. So that's how we get to our $5,600 amount. Next one is our inventory adjustment. So if we again look back here, we can see that 60% of inventory was sold on 1 December 2016 and the remaining amount in the current year. So this 60% of inventory related to a prior period. So again, we look up at our table here, we can see that inventory had a carrying amount of $70,000, but a fair value of $100,000. So when this 60% of inventory was sold in the prior period, Rareco, who is the associate, would have used the $70,000 amount as their cost of inventory. But from our perspective, being the acquirer, we need to use the fair value of the inventory at the date of acquisition as the cost valuation for our inventory from our perspective. So when this 60% of inventory was sold, Rareco would use the $70,000 to calculate the 60%. So if we take 70,000 multiplied by 60%, that gives us $42,000. So Rareco would recognize $42,000 of COGS when that 60% was sold. But from our perspective, we want to use the $100,000 fair value as our cost base for our inventory when calculating COGS. So Rareco recognized $42,000. If we multiply 60% by 100,000, we would want to recognize $60,000 of COGS. So we want to recognize $18,000 more COGS than Rareco. So we want to recognize $18,000 more expenses. But again, we need the after-tax amount. If we multiply 18,000 by 0.7, we get $12,600. So then when we add up the totals between our increases and our decreases, we get $44,800. Now, because we only own 25% of the associate, we're only entitled to a 25% share in the changes in equity. So if we multiply 44,800 by 25%, we get $11,200 increase. But if you remember earlier, I said that a bargain purchase upon acquisition for equity accounting, we need to include this bargain purchase as our share of equity in the period of acquisition. So the reason this is, if you remember, when we recorded our initial investment at cost, we recorded an investment asset of $200,000. So we know that we paid $200,000 for our 25% share in the company. But because the total equity was $1 million, we were actually entitled to $250,000 of net assets, despite only having to pay $200,000. So by recognizing this $50,000 bargain purchase amount in our share of prior period equity, what it does is it ensures that we reflect the value of our investment at the amount of net assets that we actually received, because we will put this $50,000 bargain purchase into our equity and we'll be increasing our investment account by the same amount. So it makes sure that our investment account appropriately reflects the fact that we acquired $50,000 more of net assets than what our initial cost recognition reflected. So when we add in that $50,000 bargain purchase, we have a total share of $61,200 of prior period equity. So again, continuing with step 2, we have the current period share of equity. So we need to worry about this if the investor is a parent or if they're not a parent. So regardless, either way, we need to calculate the current period share. So if we go back to the financial statements, we can see the profit for our current period was $62,000. So we know immediately that profits, we should be entitled to our fair share of those profits, and they're going to increase our equity. So we'll put it in the increase column. Our movement in general reserve, similar, exactly the same to our calculations in the prior period. We know that this $5,000 amount was retained earnings, but all we've done is we've taken it out of the retained earnings account and put it in the general reserve. So we've transferred it from one account to another. So despite this transfer, we know it was originally retained earnings, and so we should have our fair share of that amount. So we will put that $5,000 amount, which was transferred out in the current period, into our increase column, because we should be sharing some of that amount. So the next one, our depreciation adjustment. Again, similar to last slide, so the prior period calculation, except this time we only are worrying about the current period, so we only need 1 year of depreciation adjustment. So we know that our machinery had a fair value of $120,000, but Rareco had a carrying amount of $100,000. So because the useful remaining life was 5 years at the date of acquisition, we needed to depreciate an extra $20,000 over those 5 years. So it'd be an extra $4,000 per year. So because we're only making the adjustment for one period, the current period, we only need to have $4,000 depreciation adjustment in the current period, but we know we want the after-tax amount. So when we multiply that $4,000 by 0.7, we get this $2,800 that we put in the decrease column, because from our perspective, we should have higher expenses, so we will have less profit. But this also means less tax, so they will offset. so that we have a net decrease in our share of equity of $2,800. The inventory adjustment, again, a similar thing. If we look back to our financial statements, we know that the remaining amount of inventory was sold in the current year. So that was that 40% that we had left over. So we know that Rareco will recognize the cost of inventory using the $70,000 carrying amount. But from our perspective, we need to recognize the cost of inventory using the $100,000 fair value. So Rareco would recognize COGS 40% of the $70,000, which is $28,000. But from our perspective, we want to recognize COGS at 40% of $100,000, which is $40,000. So as the investor, we believe COGS should be $12,000 higher, so our expense is $12,000 higher, but we know that this means we will pay less tax because our profits will be lower when our expenses are higher. So when we have that after-tax amount, so we have the $12,000 adjustment multiplied by 0.7 to give us the after-tax amount, we know that the net decrease in equity will be $8,400. And so we need to share in that decrease because we own 25% of the net assets. So when we add up the totals of our increases and our decreases, we get $55,800. Now, we only own 25% of the associate, so we take our 25% share, which is $13,950. But in the current period, we also have an adjustment to OCI. So if we look back at the question, we can see that Rareco revalued assets up $5,000 in the current year. So we have a revaluation of assets, which means that equity has increased, but this is considered to be other comprehensive income. So we know that this $5,000 revaluation is income. It will be taxed. So again, we need the after-tax amount. So if we take the $5,000 multiplied by 0.7, we can see that we get $3,500 after-tax amount for that OCI share. But then we only own 25% of the net assets. So when we take 25% by 3,500, we get $875. One thing I'll point out quickly as well, these formulas are just a little bit wrong here. So we just need to multiply that amount by 0.7 and that'll give us the after-tax amount. And we just need to multiply this by 0.7 as well to give us the after-tax amount. That's correctly reflected in the numbers here. I just wanted to make that adjustment to the formula. Okay, so now we are up to doing our equity journals for 30 June 2018. So I don't want to confuse you. So far, we have done step one. We've recognized our initial investment at cost. Why did we do that? Well, because the question asked us to do the journals at 1 July 2015 and 30 June 2018. We've done step two. We've calculated our prior period share and our current period share of equity. So now we need to actually record those changes in equity in our accounting records. So if the investor is a parent, what are we going to do? Well, we will debit investment in associates by $61.2 thousand and credit retained earnings opening balance by $61.2 thousand. So this is recognizing our prior period share of equity. So if we look back at our calculation for our prior period share, we can see that we had a net increase of $61,200 of equity that we need to share in. Sorry, that is our fair share. So what we do, we debit investment in the associate by this amount because we want to increase our investment asset to reflect the fact that we've actually received more equity from the operations of our associate. Now we're crediting retained earnings opening balance because our share here is profit. It's income. Now, because we're dealing with prior periods, this profit would have been closed to retained earnings at the end of those prior periods. And because now those prior periods ended at 30 June 2017, but now we're doing the journals at 30 June 2018, so we need to make the adjustments to the opening balance of retained earnings going forward. Okay, so our next entry, we will want to recognize the share of profits in the current period. So we debit investment in associates by 13.95 thousand and credit our share of profit in associates by 13.95 thousand. If we look at our calculations, we can see that our 25% share of the profitable operations of the associate after we've made our adjustments is $13,950. So we need to increase the value of our investment asset by that amount because we have received an increase in equity from those profitable operations. And we're also going to recognize our share of that profit in our retained earnings. The reason we credit it to the share of profit in associates because we just want to split out on the balance sheet how much of the profit is from our associates' operations and how much is from our own operations. So the next thing we are going to do, we are going to deal with the OCI from the current period. So again, we look at our OCI amount. Our 25% share from our calculation was $875. So we're going to debit our investment in associates by that $875 and credit our share of OCI of associates by $875. Again, we've received that OCI. It is it's income, it's other comprehensive income. And so that increases our equity. So that's why we credit the share of OCI. And we are increasing our investment asset to reflect the fact that our investment in our associate has returned or has generated income for us. So the total equity that we're entitled to has now increased. Now with that treatment for that OCI amount, we need to move it from the OCI recognition account to the revaluation surplus. Now the reason this is because we know if we look back at the question that this OCI amount came from a revaluation of assets. So we need to have that accumulated equity from the revaluations in our revaluation surplus so that if we make further adjustments to the value of our assets, we can offset it. So if we were to decrease the value of the asset, we can offset it from our previous increase. So effectively, we just need to accumulate the value of our revaluations in this surplus. That's why we're transferring it in. Now, our last entry is debit dividend revenue, $4.25 thousand, and to credit our investment in associates by $4.25 thousand. So we know, if we look back to our financial statements, in the current period, if we add up the dividend paid and the dividend declared, that's a $17,000 amount. So we would have recognized revenue equal to our fair share of that dividend. So we know that $17,000 is the total amount. We're entitled to 25% of that dividend. So when we take 25% of the $17,000, we get $4.25 thousand. So we want to offset the revenue from the dividend we would have calculated because it's effectively just a transfer of cash from our associate to our entity. So we don't actually want to recognize revenue. And we are crediting our investment in associates because when our associate pays out that dividend, they pay it from their retained earnings, which means their equity falls, which means our equity also falls by a 25% proportionate amount because we own 25% of the net assets of the associate. So when the associate's equity falls by paying out the dividend, our equity will also fall by the amount of the dividend that we're entitled to. So effectively just returning some of the equity from the associate back to us. Okay, so now we'll go through the equity journals if the investor was not a parent. So this first journal doesn't exist. Why? Because if the investor is not a parent, we only need to worry about the current period's share of equity. So we don't need to make any adjustments to the prior periods. These three journals in the middle are exactly the same. That's why I had them in a different color there. Sorry, they're not formatted great there. But then the dividend journal at the end changes slightly. So what are we going to do? We're going to debit cash by $3.75 thousand. We will debit a dividend receivable by $0.5 thousand or $500. And we will credit our investment in associates by corresponding $4.25 thousand. Why? Well, firstly, if we go back and look at the question, we know that $15,000 of a dividend was actually paid and $2,000 was declared. So when we take our 25% share of $15,000, that was actually paid out in cash, that comes down to $3.75 thousand. 25% of the dividend declared is $500. Now we know we will receive that, we're entitled to it, that's why we recognize the receivable, we just haven't actually received it yet. The reason we're debiting cash is because we consider it a return of equity, not actually any dividend revenue, it's just a distribution from the equity. And we credit the corresponding investment in associates because the dividend was paid out of the retained earnings of our associate, so their equity has fallen. So to reflect the fact their equity has fallen, that means our share of their total equity has also fallen. And so we reduce our investment asset to reflect the fact that there is less equity for us to share in now. So that's the end of the video. I hope it was useful.